button here, and this is the September 2019 edition of the monthly market update, which I have been calling the green sheet lately. So here's the legal disclaimer that you guys are all, and if you guys don't know who I am by now, check out the podcast, check out the Spotify, Simple Passive Cashflow. For those of you guys aren't in Hawaii, unfortunately, you guys can't come to my meetups out here, and but we'll try and make it out to you guys at some point. So here are the articles and podcasts I've done this month. Posted the live coaching call with another non-accredited investor. People seem to like these. And this thing is another engineer. I think half of you guys are engineers that listen to this stuff. And then Hunter Thompson, he's from Cashflow Connections. I thought that was a great philosophical podcast we did. That was probably a while back. And then this newer development, which is illegal SEC practices with a lot of these syndications out there. So what's happening is a lot of capital raisers are raising on one deal, because a lot of guys, they can bring in, $250,000, $500,000. So what you're seeing is on some of these deals, like 12 people in the general partnership. And it's super clear that from the SEC's perspective, once you start to dig like one layer deep, that people are raising money for compensation, which is a huge no-no. SEC is pretty explicit in saying no sponsor-based compensation. So go ahead and Amy Wan, we had her on the podcast. She's a syndication attorney. She sent me an email the other day, so I put it in here just so you guys can go and read the article yourself. But this is the reason why I only kind of go into deals with people I know, like, or trust, and it's a smaller deal too, so I can kind of control who I work with, because I've talked to a lot of syndicators who've done this in the past, and they don't do this anymore because it's just a huge liability. It just takes one rogue capital raiser to trick people into investing, and then those passive investors sue the general partnership. And as soon as everybody has egg on their face, even the other LPs that were totally innocent, they're kind of wrapped around in the lawsuit too. So I would go check that out. The other podcast that I had was on timeshares. If you guys have any timeshares, I would check out that podcast, and I can refer you out to these guys who help people exit their timeshares, because I think they're pretty bad deals in my opinion. But they're kind of saying that most of their clients are old people, since these old people are sort of like, they've been paying these maintenance fees over the years, and now they just can't afford it. Probably similar to life insurance investing or life settlement investing. People at the end of their life, they just run out of money and they can't pay it. So before we get running through some of the data and articles, here is just an example of something of what I call bad data. So on this middle row here, it says number of units completed or coming online, and Dallas is there, and you interpret this as, oh, Dallas has a lot of units coming online, maybe that's going to push down supply. But when you break it down by percentage of stock, Dallas is not even on there, right? Seattle's still number 2. So I always kind of look at this and have not really attention to detail, but like just kind of call BS at some of this data sometimes. Newer investors will always say, oh, I was looking at this top 10 places to have rentals, and I don't really look at those things, to be honest. I mean, they're always skewed in one way or another. I think they put like San Francisco as the top rental market in one of those kinds of things. We all know that's
wow.
A little late on that.
Yeah. So here is some, if you guys want to take a screenshot of this, and if you want to share this with some buddies who are still working with financial planners and stock people, this clearly shows how all these fees are just screwing people over the years. So bottom right is with no management costs inputted in, and you're able to make $3.3 million at the end of it. 2% upper left hand corner is you're showing like $1 million going to fees, and that 1-2% seems like a little bit, but for a lot of times it's like 20% of the gains every single year. The Yardi report is something I read quite often. It comes out every month. If you guys, I usually have a link in the show notes on the website for this monthly GreenSheet. You guys want to just go to there and access it, or you guys can subscribe yourself. But some of the bigger takeaways is, they're saying year-over-year growth is 2.4%, and rent growth is going up 3% year after year. Again, I don't really use those numbers. I use more like 2%. I think it's more of a conservative underwriting number. Inventory coming into the pipeline here. So this can be an indicator that, there's new development coming online, and that can be a good sign, but it can also mean, there's too much development and now your rental property is going to have a whole bunch of more competition. So, I think Texas is always on fire, and that's why, they're building there, because they know it. So Freddie Mac. So here's a kind of interesting thing. I got a email from my lender, and they were saying that they were over their quota on number of loans they were doing this year. And this is for apartments, but it just kind of goes to show that a lot of people are doing deals. Not to say that they won't be doing more loans. It's the government. They'll find a way. They'll just, keep it going, keep the good times rolling. It's not like he's going to sit on his butt for the last 3 months of the year. He's still got to work. But Freddie Mac predicts 8% increase for 2019 multifamily loan origination volume. Pretty self-explanatory. Here's another report that shows the new supply coming online and the inventory growth. Again, it's, we're talking about 0 to 3% here. There was the way I interpret this is that there was some new supply coming online in the last few years, and now that's tapered a little bit, but the demand is sort of still there. I think that this is on a national scale. I think it's more important to key in on like the individual markets and individual submarkets, because you can't get really submarket data like this for sure. The yield spread is something that, like mortgage brokers, they always, this is just really bad advice. They always say, hey, you got to refinance your home, or you got to buy now because interest rates are low. But as an investor, I don't really care what the interest rates are, because the cap rate, the line in the orange, sort of mimics where the interest rates are. And as investors, you're making money off the delta between the two. And then, of course, you're applying leverage. That's essentially what we're doing as investors. You're borrowing at this much and you're making this much, and what's your spread? And the reason why we like real estate so much is you get pretty good leverage terms on this stuff. So if you look back on 2007, that was not a good time to be an investor, obviously. But when you look at the chart, there was like a very small delta or spread between the cap rates and the interest rates. So you weren't able to make much yield. The yield is the spread between this. So right now, we're kind of in a sort of a divergence, which is actually good for investors. If you look back in mid 2018, it was kind of getting very close to where the cap rates were. And some people will say this is wrong, but I call that cap rate compression. That's when you're as an investor, you aren't making that much money. If you guys have any questions, feel free to interrupt me. All right, what are we looking at here? So there's always these, is multifamily overbuilding. Here's some of the new units coming online from way back when, from the 1980s to 2000s. And remember, a lot of this is just replacing a lot of the old inventory, the Class C stuff, because the Class C goes to D, and eventually they just destroy the stuff after a while, and then they build something new, and that's how it makes it on this chart. So I think we're told, it's nothing unprecedented where we are at now. Here is some of the high-level takeaways from, I think this was the Yardi report, or I think it was a quarterly report. If you guys want to read that later, I mean, nothing too groundbreaking here, but it's just nice to sometimes read it how an industry person would write what's happening, as opposed to a lot of us, myself included, reads a lot of headlines, and you get inundated by all this mainstream media, which is all about getting the average person to go buy a house or to scare them into that. We've been following this China trade saga for quite a while. The latest thing is that the media is trying to portray, to sell headlines and sell newspapers, is that the Chinese yuan to the US dollar has fell below the 6-7 ratio, and they're saying that now the world is going to end. I don't know if that's the case, but it is sort of been falling. So if this is new to you, the USA raised taxes on China, not Chile, as it says in the report here. And China is responding by lowering their economy by weakening the yuan. So it's kind of like, yeah, take that. That makes the US exports more expensive. And that was why the Dow dropped maybe about 2-3 weeks ago, 700 points. I think a lot of us actually forget. I forgot. I don't even have any stocks anymore, so I don't really pay attention. But that 700 point day seems like a while ago. So this is going to continue to develop. I don't know where this is going to go. But if you guys are interested in this China trade saga, it seems to be a big indicator where we're going to go with the economy. I would listen back to the Richard Duncan episode that I did and the Moneyball guy. I think there was like 10 podcasts ago. Some interesting ideas behind this China trade deal, and saying that if Trump can get a deal signed with a desperate China or weakened China, he can really power the economy forward for a year or two, and that will likely get him reelected. And he's saying that we're in for this another bull run to go for another 4, 5, 6 years. I don't know if that's going to happen, but that's just a theory. So it's kind of interesting just hearing that point of view, especially when you're inundated by all this doom and gloom every day. Everybody's trying to be like Peter Schiff and predict the next recession, and they keep predicting it every single month. So everybody knows like the yield curve, the 2 and the 10.
Yes, sir.
Inverted. Which doesn't mean it's not a precursor for a recession. Mathematically, yeah, it happened before, but that doesn't mean that it's going to happen. I think, again, it's selling a lot of newspapers. But the Fed did cut rates for the first time since the recession. So that's big. But some will argue that they shouldn't have raised the damn thing the last time. And they're just kind of fixing what they did last time. But nevertheless, the equity markets has been like a roller coaster, as it always has been the last probably decade or so. Here's an article from more of an industry commercial property executive. And like I said, it's always interesting to see what these guys make out of it in their commentary. So again, here's that email that I got from Freddie Mac saying that they've already hit their lending quota for the year. And all these resources will be available on the, if you guys go to SimplePassiveCashflow.com and go to investor letter, /investor letter, that's where I keep all the slides and the notes for these. If you guys haven't, please join the investor club, SimplePassiveCashflow.com/club. And we will get into the second half, which is kind of what I've been up to personally those last month. This is the slide where it's all about money, not all about money. I haven't really done much fun stuff, so that's why this page is blank. I've been working on some deals, but in terms of growth, I have set aside a 1 hour time block in the evenings to actually work on some things that improve myself as opposed to just get through the day-to-day. I've been minimizing my podcasts because in my opinion, podcasts are just a means of marketing, and it's just the same stuff over and over again. Most podcasts. Hopefully you don't think of that as Simple Passive Cashflow. But I've been getting more on audio books lately. So I'll talk a little bit about the book I've been reading lately. Number 2, contribution. And these are all ways that I kind of like infuse into my day and my month to supposedly make me more happier, because that's what it's all about. But here's the way I contribute back to people. I mean, I think this is a travesty, like how people are paying all this money in mutual funds, even index funds, for all these fees being taken out. Here's a great breakdown of, how someone's getting screwed over 5.82% in their mutual fund without them even knowing it. And they think that the expense ratio is 0.9%. Again, you guys can take this to your buddies and show them this stuff. On my Facebook channel, I've been created like a little thread called Flog Your Financial Planner Friday, where I just add to this everlasting chain. If you guys want to add some stuff, that'll be on Friday, but you can post any day if you want. Some significant thing I've done in this past month, I spoke alongside my mentor, Robert Helms, who I used to listen to his podcasts maybe 10 years ago. And it was really cool to sit next to him. And I was part of his mastermind a few years back. And, it's great to kind of connect with him, and I see him a lot these days. So that was really special for me. Tony Robbins says you need a little uncertainty in life. So this is my uncertainty in life, is this stupid Atlanta rental that my tenant messed up. If you guys haven't checked out the podcast, not the podcast, but the YouTube video where I did like a reaction video of it, it was sort of my fun way of showing it to people, even though I saw the video a few times, so it wasn't really a surprise to me. But still working our way through this one. I'm probably about $25,000 or $30,000 of repairs into this thing.
Gee.
And the thing on the left, like the trash out, it's like, oh man, like you fix this thing and then you get another bill for $34.50, and it's just like, man, when does this end? And then like we got the windows put in, and then somebody shot out the windows with a BB gun. It was like another $400, and I'm like, geez, let's get rid of this stuff. Let's get rid of all these single family homes and just move the syndications. The other point of uncertainty is certainty, and I'm selling this thing. So I actually got some offers on it a few days ago. I posted this in the Hui Facebook page, just sort of education, so people, 25 people voted for that first one, which was obviously the best offer, $135,000 all cash offer. But I posted there just so people can, who don't know what is the best offer, see what other people choose. My plan, what I normally try and do is I list these properties 95 to 90% of market value to inspire multiple offers, and especially entice those cash buyers to bite. Because I'm not making this stuff too nice, right? I'm trying to cut corners with the rest of us. So I don't want them to tear me apart on inspection, right? Some other love and connection things I've done. So the upper left-hand corner, that's a picture of a barbecue we did at one of our apartments recently. Bottom left is a little Hawaii investor club meeting we did. People are always scared about revealing their identity, especially if they're accredited investors. So we had a mask there. Just kidding. But the upper right, I went to a self-directed IRA summit, learned about that. Still not a fan of self-directed IRAs or yeah, definitely not a fan of self-directed IRAs. I don't know why you'd want to use them. If you guys are using them, and I would check out SimplePassiveCashflow.com/QRP. The QRP is way better in my opinion. You don't have the UDFI tax. You don't have the, it's a lot better. Self-directed IRAs, you have to pay the UDFI tax on the leverage portion, and you better be using leverage in my opinion. That's the whole point of using real estate. And then the bottom right was a picture in Dallas, and I'll be in Dallas again this weekend.
We'll see you Saturday.
Oh, is that you, Jim?
Yes, sir.
All right, we'll see you Saturday. How hot is it out there?
About 90.
Oh, geez.
Yeah.
Well,
Bring your sweat clothes.
That's why we're doing it early. So
that's a good idea.
We're gonna walk some properties on Saturday. Some resistance and barriers in my life, again, that SCC practices. Read that article there. I was watching I don't know why I was doing this. I was watching like a financial planner seminar on how to be a financial planner. And I was just like appalled by like some of these things that they do. Like they're like, this is how do you like work with millennials, they said. So number one, they said subscriptions like Netflix, because number one, millennials are broke anyway. They can't even afford a financial planner, but they can afford like $125 or $500 a month. So they said, do that. And then they said, don't focus on income and expenses, because again, millennials don't have assets, but focus on, the balance sheet, the cash flow statement. And then number three there, this is a typical financial planner scheme, which is charging a sort of a minimum of $2,000 per year, or going to that monthly subscription, or charging a percentage, usually like 1% of AUM, which is assets under management, which I'm like, is messed up, right? Like that's a huge portion of like even your salary, for someone to just sit on their butt and collect commissions on top of that. Anyway, my entire rant on financial planners at SimplePassiveCashflow.com/FP. You guys want to read that in your spare time. And then I've been reading The Miracle Morning. Now, did any of you guys ever read this book? I wasn't a huge fan of it.
No, I've not read it.
Yeah, there's a big online community of like, I don't know, like 50,000 people in a Facebook group that like swear by it. They're super motivated people. And I don't know, I think I call them like the sort of the Cameron crazies of Duke, grow up and need a life. I think that of this like more Miracle Morning people who like swear by this stuff. The whole premise is you wake up really early, and then you do your morning affirmations, you work out, you basically do all the important things, which I think is great. My takeaways was like, don't check your internet every single day, the first thing, which I still do. I have to do that. I mean, by the time I wake up, you guys are halfway through your guys' day in Texas or East Coast.
Right.
So that's not practical. But the one takeaway I did take was, he's like, you don't need 8 hours of sleep. If you're switched on and you're working towards your bigger goals, you should let that drive you throughout the day. I don't know how far you want to take that. If you just want to sleep 1 hour a day and let hard work and determination power you throughout life. But I think mentally, like somebody told me, like, say they're only going to get like 5 hours of sleep. Most times I would be like, man, this is going to be some rough sleep. Well, I've sort of adopted a mindset of like, look, this is going to be a really good sleep. And, I don't need 8 hours. That 8 hours of sleep was a limiting belief. And I'm not giving out health advice here, but if you can, it starts with your mind first is the whole point. Some stuff I bought. This is my doodad of the month. I bought this Papa Shot thing for $275. It's probably
That's cool.
The funnest thing I ever bought this year. Me and my wife play it all the time. I've got more things on. If you guys find me on kit.com, I've got a whole bunch of goodies on there and like books and business books that I recommend. You guys can check out my whole. That website's pretty cool. Every time I find something fun like this, I put it up there. Some lessons learned this month. I'm trying out this new LastPass thing because I spent so much time and have so much headaches dealing with all my passwords. And yeah, just some more hacks there. You guys can read through later. Oh, yeah, here's another rant that I have. You know those insurance companies that's supposed to pay you out when something messes up? Well, my insurance company doesn't do that. So maybe I can use your guys' one. But yeah, single family home landlord insurance is useless in my opinion. The multifamily commercial stuff actually works where we can get them to pay out new roofs for hail damage. But yeah, I had these single family home landlord insurance are pretty useless in my opinion, but I guess you still need it anyway. Something fun, I saw this, like these guys on Reddit, they put Roombas on, they're playing beer pong. They put the cups on Roombas and they put the Roomba on the table and Roomba moves around the table. So it's like another dimension of beer pong. So yeah, always innovate. People are always innovating out there. Here's an Easter egg. If you guys haven't heard of the Passive Investor Accelerator Mastermind, I used to call this the Mastermind, but now I'm calling it the Passive Investor Accelerator and Mastermind because people think of Mastermind and they think, ooh, that's so advanced. That's not for me. I'm still learning. But you know, the whole point of the group is that everybody's sort of learning. So I thought the word accelerator was more of an appropriate term, so people aren't as intimidated. But mostly high-paid, accredited investors in that group. 27 weeks of content, and then we do these Zoom calls every 2 weeks. And people, you know, we're gonna kind of go back into the networking after this presentation. But any people who are listening live have any random questions before we go back to the networking portion, the last 10 minutes?
I'll ask in Dallas.
All right.
Hey, Lane, I have a question here.
Yeah, go ahead.
So any lessons learned over the last couple of years just in your journey of syndicating?
And what?
Or maybe just in this last year, like any takeaways from any deals that you've been in?
Work with operators that are proven, and make sure there's enough gas in the tank when the plane takes off, right? Because what you don't know in a lot of these deals is execution, right? And execution, when it comes down to it, is, you know, the tenant moved out, did they rehab the unit right away, right? Now, we're humans. It's not going to happen right away. But that's why you underwrite with the right reversion cap rates, and you underwrite it with the right, you know, conservative assumptions. Like you don't want to use 3% rent increase per year, so that when there's not total efficient system, you still come out to where you probably projected to be. Because you can't do it perfectly. You know,
Right.
This is real estate investing. It's not a huge science. You know, if it was a science, a lot more smarter people would be doing this. But there's a lot of art to it. That's kind of my takeaway. And I'm still investing, you know. I mean, that's why you kind of go into a lot of deals, and you kind of focus on cash flow, because the cash flow will keep you alive. Good question. All right, unless somebody has something else, I'll cut you guys loose for the rest of the hour to do one more round of networking. And for those of you who are listening in on the replay. We'll see you guys next month.